Hello and a warm welcome to this week's edition of Econoday Unplugged. It's Tuesday, the 16th November 2021. Mark Pender's on the US East Coast and I'm Jeremy Hawkins in London. So last month, US inflation surged to its highest level in more than 3 decades. And on Wednesday, we're likely to get confirmation that its Canadian, Eurozone and UK counterparts have jumped to their fastest rates since 2003, 2008 and 2011 respectively. With few exceptions, consumer prices in the major industrialized countries are running well ahead of earlier expectations, and those central banks still towing the rising inflation is only transitory line are finding themselves firmly on the back foot. However, policy responses will not be uniform, especially with sharply rising COVID infections in some regions, notably Europe, raising fresh doubts about the economic outlook, all of which could well mean an even stronger dollar over coming months if the US real economy behaves itself and supports already building speculation about early Fed tightening. So on which note, Mark, we've got to kick off with last week's CPI. I mean, was it as much of an inflationary shock as first appearances might suggest, or were there any sort of mitigating factors in there we need to take into account?
Well, it's centered in energy, although that's a very important element of inflation. But it is pretty broad-based, and it really does. You're talking about the transitory view, and it's really looking like kind of almost like a dogma to me. It's almost like a short war dogma. When you're in a battle, the war is going to be short, and it just drags on and on and on. This kind of acceleration was not expected. It was 0.9% in the month. That was almost double Econodays consensus, and a couple tenths outside the high expectations. The core, which excludes food and also energy, which I mentioned, that was up 0.6.
When was the last time? Do you remember last time we saw a figure that high for the core? Off the top of your head?
I think. Well, we're going back to breakdowns are going back to either to the early 90s or they're going back to the 70s. So. And what was even more kind of alarming after that were the consumer expectations numbers that came out. Inflation expectations now are what the Federal Reserve, Jerome Powell, concentrates the most on, and saying that you can have these blasts of inflation lighting up the sky, but it's not going to, as long as it doesn't affect how people spend or think about psychologically spending their money. Are they beginning to buy things in anticipation ahead of the game, thinking that, well, the price is just going to go up, we better get it now? When that starts to come in, then it'll be a greater self-fulfilling prophecy. Well, the University of Michigan's number on that is also went up another notch, and they're at 4.9%. Which is, that's a huge number for these readings. That goes back to the Michigan's numbers go back to the 60s, and this is the highest since the 70s. And respondents reported rising prices for all the important things, homes, vehicles, durables, and they haven't seen that since the days of the Iranian Revolution. So. Were affecting oil prices. So this is something, the policymakers, and it's interesting what the ECB is doing, because they seem to be, they recognize it like the Fed does, but, well, I'll let you talk about the ECB. But what the Fed had been doing, they've been preparing us for just a short little, it's going to be a quick little war, and then the war is now dragging on. The war is now getting more. The war is getting greater right now. We need more, throw more material at the war. So
okay, on that front, earlier on today you had out some of the real economy data. I'm taking a look at retail sales. Are there any signs yet that rising inflation is hitting the retail sector, or is it, as you were saying, perhaps it's the case now whereby consumers are buying early because they're worried about future price rises?
You could make that argument. The retail sales came in 1.7% monthly gain. It has been soaring, and that was near the top end of the consensus range, and it showed wide gains. Strong gains, and it could very well be that it's taking hold. Certainly in a short term, going back to the University of Michigan, one of the details that's Jerome Powell is certain to mention is that the 5-year expectations have been steady. So there's your inflation, your long-term inflation expectations. It hasn't, it bled over to that, but it's certainly, it may be picking up steam, and it may be, part of if people are going to make a decision, if they're on the fence of buying a car, or they're on the fence of buying a major appliance, and they just see the prices go up, and they are going up here in the U.S. I mean, you can see this in some of the shops. And I was just going through, I don't want too much anecdotal data, but I was going through the shops, and I noticed that that some of the price stickers were off, and so you have to go up and ask, right? And then you're always shocked when you get these numbers. No wonder you rub that out.
Can't change them fast enough. Yes.
So yeah, there's definitely a little bit of this, picking up of prices, and how much will it have legs of its own? Will it get out of hand? Will it shoot past? Is the Fed already behind the curve? These are the questions that they have to answer. They have to answer to this, because behind all the Fed's emergency policy has been this talk of, are you going to watch it? Are you going to get this out of control? Are you going to make sure you keep it in control? Yes, we're all fine. Well, it's not so fine. Had they known what these numbers would have been back in March or earlier in the year, maybe they would have started tapering sooner. Maybe they would have brought up some of their rate hike estimates, in their forecasts. So it's an interesting issue. But let me ask you about the ECB now. You were talking about we're going to get some the European inflation data. It precedes the U.S. There's one important indicator that the Europe is faster with. What are they seeing, and how is Christine Lagarde, playing this?
Well, I guess it's, and I think there's some real trading opportunities which have been, well, I suppose emerging for a little while now, particularly in the currency markets. And it really is because we've got this lack of synchronization between what's happening on your side of the pond and what's happening in the likes of Europe, and indeed you could say Japan as well. And that's really because, as far as particularly Christine Lagarde's view, is very much still that it's the transitory. But she was talking to members of the European Parliament about inflation yesterday, and her view was, okay, so inflation has been higher for longer than we originally expected, but nonetheless, essentially, it's due to a number of one-off factors, specifically the rise in oil prices, which she doesn't expect to last for too long, the dislocation between what we have on the recovery in demand versus supply, because of the supply chain disruptions, etc. That's hitting output much more on demand. So at the moment, we're in a position of excess demand, which ultimately also, should start to fade away as we go through next year. And of course, sort of technical distortions, notably the cut in German VAT, which came through in the middle of last year. So, according to the ECB and certainly Christine Lagarde, inflation in Europe, although it'll be harder than originally expected next year, will still start coming down and be close to target by the back end of 2022. So, in other words, if you take her at face value, there's no point in raising interest rates now, and indeed there's no point necessarily even rushing into any kind of aggressive tapering. It's very much the case at the moment that the European Central Bank stands not necessarily alone, but certainly amongst that group of central banks, which is hugely reluctant to come out and do something to potentially impact the real economy negatively. And I think, although she may well be proven wrong, one big aspect over here, which is unfortunately coming back into the sort of policy limelight again, and that's what's going on with COVID. Europe really has become sort of the epicenter for the latest wave of COVID. We've had record infection rates being announced, out of Netherlands, out of Germany. We've had a new lockdown being introduced in Austria.
And from an economics, unfortunately, from an economics point of view, this is disinflationary. Can we make that assumption?
Well, it may be, not necessarily, no. What it's going to do is going to hit output quite clearly, because although we haven't got the same hard lockdowns that we had earlier on this year, essentially what we're talking about is fewer workers being able to work in their normal capacities. So it's going to hit output. Now, to the extent that consumers will still continue to consume, the risk in many ways is actually becomes inflationary, because to the extent that we have demand already growing too quickly versus supply, if we see that gap widening still further, it's going to increase yet further, pressure on consumer prices. So the last thing really the ECB wants to do at the moment is to do anything which is, it's going to really start hurting the real economy.
So COVID is increased rates are an inflationary risk.
Yeah, it depends on the individual countries, but we look at the relative growth rate, say, of demand. Well, bear in mind that if we just go back to the European real economy at the moment, you're still talking about an economy that has yet to get back to the level of output it was working at before COVID actually arrived, whereas retail sales at least are about 5 percentage points or so above. So demand's recovered a lot more quickly than output has during this COVID period. And if we get output being hit again, which already we have clearly due to all these supply chain blockages and so on, it's just going to exacerbate what's going on.
But if they have restrictions and lockdowns, is Europe going to do that? I mean, are they actually going to, go back to something that we've already seen that would hurt demand like that?
Well, they're talking about light lockdowns at the moment. So Austria has introduced one form of lockdown. I think the Netherlands has introduced, again, they call it sort of partial
these
lockdown.
are interesting. The Austrians, a very politically sensitive way to do it, right? To limit the unvaccinated's access to shopping and those kinds of things. You wouldn't see that in the US.
That is very much happening. I mean, even in France now, they've introduced a rule, I think it's middle of December, everyone over the age of 65 will now have to get booster shots to remain eligible for the vaccine passport that they need to gain access to a whole range of public places. So, basically, without spending too long talking about COVID, the bottom line is it is very much a big policy issue over here. And it's one factor which is going to ensure that the doves on the governing council, European Central Bank, will not want to change policy. And of course, if that's the case, and we've got all this speculation from what you're talking about with inflation stateside, in fact, the real economy also appears to be doing quite well. We're talking there about speculation that the Fed's going to have to tighten sooner rather than later. The ECB ain't going to tighten for the foreseeable future. And if one law does still seem to hold in particularly the FX markets, bond yield differentials do have importance, say, in what happens to the currency market. So purely on the basis of that alone, it looks as if the dollar, which is already having a very strong run at the moment, could have quite a lot further to go.
Well, I'd like to point out one thing about the recovery, the reopening. I think that maybe policymakers missed this risk that, as you were mentioning, the demand numbers are so much stronger than the output numbers. But it's also, the suddenness, how suddenly it had the onset of this recovery. It's like the economy has reopened all within a few months, and it hasn't really given. It's more than just the numbers. It's the ability of the supply side to not only make up this demand, but to make it up in a short period of time. And so, I mean, is this a transitory thing? I mean, I don't know. The longer it goes, maybe it's going to be more in the transitory theme. It's going to be more extreme, but still, in length of time, it might not be that great. So, and I think that this reopening stress is could argue for maybe a more limited thing, but we'll see how the supply side does adjust. I have one interesting thing. The import and export prices came out today, and they're in the U.S. and they were sky high. I'm getting in my account day calendar right now. 1.2% on the month. I haven't mentioned this, right? That was above expectations. Export prices were up, and this is October for October. This is monthly 1.5%, double expectations. What's interesting is both the cost of air freight services on both sides of the border shot up in the 1.5 to 2% range, which kind of suggests that importers and exporters are using air freight, are substituting air freight now for traditional other forms of import export, which is kind of an interesting little detail to see in this data. So I just wanted to point that out. This is part of that supply thing I was saying, that people having to adjust in a really sudden, quick narrow window, and that itself is inflationary. That maybe the policymakers, the economists, didn't consider carefully enough.
Yeah, I'm certain it's true. I mean, looking, the cost of shipping freight now is absolutely through the roof. So really, you almost have to try and find some alternative means of getting your goods into your country if you can actually be able to, get them there in time for Christmas and so on.
And export prices, by the way, are up 18% from this time last year. I mean, that's good for, I mean, that's a lot of cost through. I mean, pass through. So that, for Europe and Asia. Oh, let me ask about the Bank of England now. You had wages come out today, right? Was that yesterday? That was today. And
that's today,
they were not inflationary, or they were less inflationary.
They were. That's right. Actually, I was going to move on to the banks. I think one of the issues which can be taken what's happening at the moment, if you're looking at what will be the key indicators investors should be looking at, I think wages is very much going to be one of them. For those countries where there is a lot of talk about potential tightening, the trigger point for so many of the central banks is going to be what they refer to as second round effects. So that's when inflation has been high enough for long enough that it starts to influence the way wage negotiations are going. And of course, if wages start to accelerate, that feeds back into consumer prices, and then you start talking about a potential wage price spiral. And that's what really worries, I think, potentially worries central banks going forward. And that's why I believe that wages will be one of the key indicators over the course of the coming months. Now, as you mentioned in today's Bank of England report, today's UK data, the B of E will be looking particularly close at what happened to wages. Now, as it turned out, they were actually relatively friendly. So without sort of putting too many numbers in the 3-month annual rate, which is the closely one looked at in the UK, that slowed from 7.2% down to 5.8%. And if we strip bonuses out of that, because they do distort the numbers, it came down from 6.0% to 4.9%. Now, historically speaking, of course, that is still a fairly chunky number, particularly when you have an inflation target of just 2%. However, the ONS, so the stats people over here, try to make some adjustments for the effect of COVID and the change in the composition of the workforce, so on and so forth. And their estimate was for regular wages, and once you try to apply these adjustments, it comes in about 3.4%. So yes, it's above the 2% inflation mark, but it's not that far above if you think you might have perhaps productive potential growth around about 1.5% or so. So I think purely in terms of the wages side, today's report is going to leave a lot of speculators thinking, well, rats. It's not clear that wages really are taking off, which would mean that's it. The bank's definitely going to hike interest rates in December, but they're still quite high, even if they're slowing. So they could still hike. So I think on the basis of the rest of the report, which by and large was pretty impressive, strong gains in employment, another fall in unemployment, and the first indications, or this early indications yet, that the removal of the key furlough program in September didn't have a big negative impact on payroll employment in October. That's certainly something the bank will be looking closely at. There's kind of something in everything in today's report, whether you think interest rates will go up or they won't go up next month. So what does that mean? Well, we'll get the inflation numbers out of the UK tomorrow, which are going to be big by the look of it. On the market.
We have a 0.8% expected on the month and 3.9 on the year. That's for the CPI. You also put out the PPI at the same time.
Yeah,
12.1% on the year on the input side, and 7.3%. These are the consensus numbers on the output side. So, is the output side then pass through? Does that represent what?
Yeah,
what
that's the important number. And we've seen a gap between output prices and CPI inflation developing over quite a while now, to the extent it's so wide. I think it's one reason why we're actually starting to see UK CPI inflation pick up. If the market's right on tomorrow's call, as you mentioned, we've got 3.9%. That would be the highest highest UK inflation rate, I should say, we've seen since December 2011.
Also, the monthly is at 0.8, which it has an echo of the 0.9 the US saw last week.
It does, although bear in mind ours aren't seasonally adjusted. So
okay.
It's always a little bit tricky looking at month-on-month numbers. Now, in terms of that, though, I mean, bear in mind that as of the last monetary policy report from the Bank of England at their last meeting earlier on this month, they revised up their forecast for inflation to a peak of 5% in, if I remember rightly, April of next year. So even if we do get inflation going up to 3.9%, strictly speaking, the bank's already anticipating that. So in itself, that wouldn't automatically mean that rates will be going up in December time. So I think what is going to be crucial as we go forward, well, yes, we've got to look at tomorrow's inflation numbers, but also what the labour market says for the December report. That will be released just 2 days before we actually get the Bank of England announcement. And if that shows wages picking up again and a strong all-round report, then I think it's very likely bank rate will go up. Otherwise,
I haven't had a chance to ask you, Jeremy. In the Bank of England, when they passed on the rate hike, which was kind of a shock considering all the expectations, tell us about is there a political component to the Bank of England? Are they completely separated? And is there a Chinese wall between what the Tories want and what the Bank of England does? Or
pretty well. I mean, at the end of the day, the target for the Bank of England is determined by the Chancellor of the Exchequer, so effectively the government. But that, to be honest, is hardly ever changed. So it's 2%, and the bank operates independently to try and achieve that 2% target. The politics, I think, comes in the sense that if we go into December time, does the Bank of England want to be seen raising interest rates just before Christmas? When COVID cases in the UK, they may be flattening out, but they're flattening out at extremely high levels. There's talks about some form of possible additional restrictions coming in. So I think, the idea of selling, higher borrowing costs to the general public, literally what's going to be a couple of weeks less than that before Christmas, the time of the meeting, makes it very difficult.
Well, the Bank of England's independence, I think, wasn't it compromised in the last decade or two? And I mean, is there a possibility that Boris Johnson could, call up the Bank of England and say, hey, don't, if you're thinking about raising rates, forget it,
Well, I think he could try it, but I think were he to do so and that actually got out into the media, then that could do the pound and everything else an awful lot of damage. So I think.
But the Chancellor of the Exchequer, that's a political post, right?
That is, that is, and he sets the target for the bank. But once the target has been set, how the bank achieves its target is down to the Bank of England. So it's down to the Monetary Policy Committee, who it should be said are appointed, of course, by the government.
Okay, so there's no political component there.
Not really. No, not really.
Okay.
Right, okay, let's think about winding this up before we speak too long. What should I mention? Yes, quickly on going back to this inflation front. Tomorrow, in addition to the likes of the UK and the Eurozone, we'll get the Canadian inflation data out for October. That's again expected to show another big number. That's expected up about 4.6% versus 4.4% last time. And it's interesting that we had the Bank of Canada governor yesterday just sounding a little bit more hawkish. If folks remember, they've already kind of brought forward their expected timing of the first rate hike to around about the middle of next year. Well, from the way Macklin was talking yesterday, it sounds as if, once we get the next Bank of Canada monetary policy report, we might actually see that being brought forward a little bit further too. So increasingly, it looks for those central banks where the economies by and large are doing pretty well. They're generally thinking now about when they're going to raise interest rates. Obviously, it's going to be all eyes on the Fed. People have been so much speculation about when the Fed's going to finally pull the trigger, but there's a number of other central banks out there which are kind of going in the same sort of direction.
And we have the Bank of Korea next week. We also have the Reserve Bank of New Zealand, and both of those are early consensus trawling here at Econoday. The panels are saying 25 basis points for each. So. Indeed. And Bank of Korea started all this.
And we've seen both of them move already. Yeah, that's right. So as we were saying earlier, it really does suggest there's going to be some trading opportunities here because we are going to see interest rate differentials moving against certain currencies, which will obviously make them that much more attractive as a funding vehicle to invest in those currencies where rates are going up. Okay, well, let us round it off there then. I guess we can say that inflation really does continue to dictate investor sentiment. And to the extent that official worries about second-round effects mean that wages are more important to keep an eye on than ever, it's just as well that all the latest wages data and indeed all the other key economic statistics and events can be found in Econoday's global economic calendar. So if you haven't already, have a look, please do, and hopefully you'll find it very useful. On behalf of Mark and myself, many thanks as ever for listening, and we look forward to seeing you next week. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market-moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your 2022 Econoday Investors Journal now at shop.econoday.com.